Hi, I'm Rick Kahler, and thanks for joining me today. Well, the bear market that we've anticipated for the last several years is finally here, and she's recently grown from a baby bear into a mama bear in record time. We are said to be in a bear market when the Dow Jones average or the S&P 500 declines by 20%. Until just a few weeks ago, even with all the market gyrations of September, we were down about 23% from the top. The precipitous drops of just the last 2 weeks have left the S&P down about 42% from the market high on October 9th, 2007. Ironically, since the Great Depression, the S&P's average drop in a bear market is about 36%. So we've dropped a little bit further than average. During the last bear market, which was 2000 to 2002, it dropped 50%. Now, fortunately, if you're diversified amongst asset classes, your portfolio is probably down about 1/2 to 1/3 of what the Dow has dropped, which could put you around, say, 25%. Now, how much further could it drop? Well, nobody really knows. Is the worst behind us? Well, historically, yes. Unless we're entering another Great Depression, one could be cautiously optimistic that the worst is behind us now. Could the markets drop more? Well, certainly, and they probably will. Should you sell out your equities and move to cash? I would suggest not doing that. In fact, this could be an excellent time to move money into the market. If history is any example, most people are going to give up and get out precisely at the wrong time. An old adage for building wealth is to buy when the blood is running in the streets. With the panic that I'm seeing amongst investment advisors and in the finance world, I'm guessing that we're getting closer to that point. I've consistently reminded clients that our returns over the last 5 years have been extraordinary, and that a reversion to the mean would be in our future. Even with the carnage of the past year, our 5-year portfolio returns are still at or slightly above our long-term expected returns. Every 4 or 5 years, most long-term investors understand that it isn't unusual that everything in your portfolio underperforms and there's just nowhere to hide. Well, that day is here. I've educated clients that 95% of the time you can see a return of a -18 to a positive 35% in any 1 year, and that's normal to produce a return of 7.5%. Now, we tested the highs of that range in 2003. Returns were in the mid-20s. This year, we are certainly going to test the lows. All this is causing a lot of stress with a lot of Americans. The American Psychological Association released new data last week stating that money is the top stressor right now for 80% of those surveyed. More than half reported irritability, anger, fatigue, and sleeplessness. No surprise here. One cause of such difficult emotions around finances is our money scripts. Those are what we think and believe about money, our thoughts about money. And they're typically operating in us unconsciously 24/7. Money scripts are partial truths, typically formed in childhood, and they shape every money decision that we make. In times of financial stress, blindly acting on our money scripts can result in irrational and destructive behaviors. For example, such as selling out everything and moving to cash during a bear market. An October 2nd Gallup poll caught my attention. It kind of shed some light on a current money script. Most respondents said their own finances have been harmed by recent events, and close to 70% expected their finances to be harmed in the very long term, or remain harmed for a very long period of time. And the fact is that the probability over 70% that short-term fluctuations in a diversified portfolio are normal, and short-term being a year, 2, 3 years, and over the long term that their finances are going to recover and be just fine. Yet for those holding to a money script that they're never going to recover from the current market declines, it's no wonder that they're feeling fear, hopelessness, and anger. We're beginning to hear the normal cries of any market bottom, or top for that matter, which is, it's different this time. I have a hunch there are different things, but it really isn't that different. So what is a battered and bruised investor to do right now? Well, my recommendation is hold on to your positions, rebalance, which is kind of a mechanical way of selling high and buying low. Be aware of your spending. Don't let your money scripts drive you to panic and sell out your portfolio. Above all, look Mama Bear in the eye and just breathe. Thanks for joining me.